Hey folks, welcome to the Wealth Webinar, a weekly webinar where we teach you how to take back control of your money by showing you how to be the bank. But today, what we're gonna do is we're gonna do something to redefine your retirement. We're gonna show you how to eliminate and mitigate the risks that most folks face when it comes to retirement. And I don't care whether we're talking about the savings up to retirement, the accumulation phase, or I'm already retired, taking an income, and I'm worried about living too long, taking on too much risk, volatility, and all of the risks. So today, in this wealth webinar, we're gonna unpack all of that. We're gonna show you how by changing one thing, changing the way you think about and use money is gonna eliminate most all of the risks that are surrounding retirement. So let's dive in. Welcome everybody to the weekly wealth webinar. I'm so pumped you are all here. And in this webinar today, we're gonna redefine retirement. But what we're gonna do is really go to all of your requests, or at least some of your requests, into the questions you had. So we always kind of have picked the topics of wealth webinar, but what we're now doing is going to the audience asking, what do you want to learn about? And you know, there's some interesting things that have happened recently. That video you were just watching has gone bonkers. So that tells me that Americans have a problem that they need solved. And that problem is a lot of Americans, they got 401ks, they've got houses, and they've got lots of equity in both of them. Their 401k's been going up, up, and up. Their house is appreciated, but the problem that a lot of them have is they don't have liquidity. The money is locked away in non-liquid places like the walls of your house, your 401k, and if you take money from a lot of those places, it's going to cost you money, and there's going to be penalties in some cases. So today, we're going to redefine retirement. We're going to talk about how you can take back control of your money, how you can be your own bank, but also how you can control volatility in the marketplace during retirement. We're going to talk about some of the retirement fears, but specifically how you can re-engineer and redefine retirement. So what we're going to do is we're going to dive into this. Now, here's the thing that's most important for you to understand, because I want to set the precedence that we're going to talk about redefining retirement. We're going to talk about changing one thing, and that one change will change everything. But we're really going to focus in and around the question that the folks had. And that question was, can I still win with the infinite banking concept? And that's a legitimate question. A lot of folks have misconceived notions that they can't do the infinite banking concept. And maybe some of them are right. Maybe they can't. Maybe some of them can't take part in some of the stuff we're going to do. But let's just talk about some of the things that people say to us offline. They say, oh, Chris or Sean or Stephen or Craig, I'm too old. All right. You're how old? Oh, I'm over 60. You know what my answer always is? Right before Wealth Webinar, I had a great conversation with a woman who was 60 years old. Her husband was a little bit older, and we ran, and Craig's got it now, but we ran some illustrations, not too old at all. Matter of fact, perfect timing, especially perfect timing for today. So Stacy, if you're on with us today, you're going to love this because it's kind of very similar to what we were talking about. A lot of people, what they're thinking about is, how do I get ready for retirement, and then how do I maximize my retirement? How do I make sure I can take the most amount of money during retirement, but without all the risks? So let me just redefine and talk a little bit about those risks for just one quick second. So if you all look over here, these are some of the retirement income risks. See, we're playing around with multiple cameras today. We're not playing around in these parts. You got market volatility. That's a risk that a lot of people fear. That's the up and down of the market, the roller coaster ride. Also, people worry about living too long. This is a real concern in retirement because in today's world, with modern medicine and everything else, we are living a long time. And now with AI, who the hell knows what's going to happen, because AI is probably going to figure out how to have us live into 150, or AI is, well, I'm not going to talk about Terminator 2, but you all understand. It's going to go one of those two ways. But we're going to have a longevity risk as long as we stick to number one. Taxes. They worry about taxes. Are taxes going to go up and chew up my retirement? They also worry about the sequence of the returns, the risk of the returns, okay? So I'm getting good, strong returns now, but what happens when the market flips and I'm not getting those returns? The sequence of when you have the returns matters tremendously when you're taking income from your retirement. Healthcare risk, inflation risk, not maybe so much right now because, you know, we got inflation kind of down in this nice little comfortable area, contrary to what the media says. Oh, tariffs are going to raise inflation. If that's a concern you have, you should be on WTF to join us every Wednesday morning. And then debts. A lot of people right now are looking at retirement and going into retirement during a period of time when they're carrying excessive amounts of debts. And that is not a comfortable feeling. You're getting ready for retirement. You're trying to have everything all ready so that when you retire, you can sail off into the sunset like all the commercials. I think Principal's the one with the big whale. You know, you're, look, honey, look at the whale. It's just like the commercial. Yeah, we all know that probably isn't going to happen. But during those retirement years, we want to make sure that we mitigate as many of these risks as possible. And we want to go into retirement with little to no debt, maybe just your mortgage. So to do that, we got to do some proper planning. We got to really focus on the things that are going to matter, and that's what we're going to talk about today. So we got a whole bunch of stuff. So again, I'm too old. That's a concern. I'm too old. I can't do this, you know, blah, blah, blah. I've heard this, I've heard that. How about solo owners? I'm a single income household. I don't think I could afford to do this. I don't think I could save that much. I don't think I could do this. You know, that person that I had on the phone today, you know, one of the things that I kind of heard her say is she said, you know, how much money they were telling her to put into the policy. And I just said, wait. They told you how much to put into the policy? And she said, well, sort of. And I said, well, we don't do it that way. We ask you how much money you're saving today and how much money you want to save in your own private banking system. We don't tell you how much to save. We ask you how much you want to save. But not only that, we don't just ask how much you want to save. We say, what is the max amount you would like to be able to put away per year, per month, per quarter? And what is the least amount? Like, because you need some flexibility, right? Life changes. It throws all sorts of hooks and curves at us. We got to have that flexibility to kind of dip, duck, dodge, dive, dip, right? How did that go? Anyway, yeah, so any of you that have watched Dodgeball, you could probably recite that, but you get it. We need to be flexible. We need to be able to kind of do those things. But we also need to be concerned, and a lot of the people that have you know, sent in some of these comments to us, they said, I have too much in debts. This isn't going to work. I'm not going to be able to retire. They also said market volatility and taxes and outliving their money are all of major concerns, just like I mentioned a second ago. And the other thing that they said, and this is the interesting one, and I hear this all the time, they're skeptical. They're skeptical, especially now because there's so much information out there and there's so much conflicting information. Oh, I heard Dave Ramsey say that this is a terrible place to put my money. I heard these two guys, you know, these stockbroker guys saying that that's the worst place you could do, which to that, me and Craig have answered all of these questions. I heard that buy term invest the difference is way better. Well, we've answered that too. We have created white papers, we have created videos, we have created all sorts of stuff to basically show you that the media, the mainstream advice is not always the truth. And I'll recite Will Rogers one time because I haven't said it in a long time. You know, Will Rogers said a really important thing. He said, in America, the biggest problem is what people think they know that just ain't so. The problem is what they think they know that just isn't so. How true is that statement? In your own family, let me just ask you, how many times have you said something to someone that you learned and they're like, oh, no, that's not how it works. You know, last night I was out with some neighbors right across the street having some cocktails. We do this like once a quarter, and I'm trying to explain to them the better way to buy a car and get all the money back. I couldn't even get through it because they were so smart. They just knew all the answers. I'm like, you know what? I'm not even going to try to show you how to get all the money back for every car you buy, drive, and own, because you clearly already think that paying the bank and giving them all the interest is way better. I couldn't believe my ears. And I'm like, you know what? Screw this shit. This is why I don't do business in Buffalo, because it's a waste of my time. But you know what? That's why I do business for a couple hundred people that join us for these webinars, because you're willing to learn something new. And that's what we're going to deliver today. So I want to open up. And I kind of already talked about it. And I want to say that it doesn't matter whether you're divorced, doesn't matter whether you've saved a penny or not, doesn't matter whether you're ready for retirement or not ready for retirement, doesn't matter if you have a pension, doesn't matter if you have debt, or it doesn't matter if you're scared. It's all about learning and doing something different, because what you've done up to this point may have worked or may not, but I have always lived by this statement. What has got me to this point is not what's going to get me where I want to go. What has gotten me to where I'm at today is not the same thing that's going to get me to where I have to be, right? And that's probably the truth for many of you. So I want to dive in. Now, we've created a whole bunch of stuff, but some of the myths, I think, are the most important things. And the myths are quite simple. And I'm going to flip my camera over because I'm going to come over here and I'm going to basically talk to you about some of these myths, and specifically around retirement. Buy term, invest the difference. Craig, you've heard about this all the time, right? Buy term, invest the difference. We've all kind of been brought up in a time where that's like the ultimate, isn't it? The lowest cost life insurance. Then you take the difference and you put it into investments. It should be one of those magical, just so you all know, if you're going to do buy term, invest the difference, definitely put it into Dave Ramsey's magical mutual fund that he always talks about on his things. You know, that 12% return. I still haven't ever seen this magical mutual fund that returns 12% every year as Dave Ramsey responds. But if you go to one of his trusted advisors that pay him money just so he says you're one of my trusted advisors, they clearly have the path to one of these magical 12% mutual funds.
But I love the fact that Dave Ramsey's got that magical 12% mutual fund, but guess how much you can take out of it every year?
It must be like 20% or something. I don't know.
Eight,
How much does,
oh, 8 to 9% easily without hurting it, because if it's always making 12, you can withdraw 8, 9%.
I remember hearing about that. Yeah, he had no idea about the drawdown effect. But you wouldn't need to worry about that, Craig, if you had Dave Ramsey's magical 12% mutual fund, because it never did any other return than 12%. So under Dave's false pretense and magical kingdom that he lives in, where he gets 12% each and every year in his magical mutual fund, like it wouldn't matter if he took down 9% or every year. I don't think it would matter.
It's still
But
going to grow, still going to be
but I
growing.
don't think any of these folks know how to get Dave Ramsey's magical 12% mutual fund, because it doesn't exist. It doesn't exist. And if all of you want to know who the absolute best stock picker in the world is, it is none other than Nancy Pelosi. I had to, Stephen, I had to. All right, so let's talk about some of the myths, right? It's too late to start something new at the age of 60 plus. We hear this all the time. It's too late. I'm too old. I'm an old dog, can't learn new tricks, whatever. You need a spouse or a big income to make this work. In other words, this is just for the wealthy. Whole life is only for the ultra wealthy. That's one that we've definitely heard a lot. The market always wins in the long run. Okay, but you don't understand the drawdown effect, which we're going to hit heavily today. And then buy term, invest the difference is always smarter. So those are some of the myths. Those are straight from our audience. Many of you probably have responded in and told us that. So let's just talk buy term, invest the difference. So if this was your strategy, this all comes from a white paper. Now listen, folks, if you all stick around to the end, we've got some free goodies to give away. So, you know, Craig called this, it's going to be Christmas in July today. So here's a couple things that are going to happen. Number one, I'm on my 6th book, but here's one of the original OG books, mapping out the millionaire mystery, that I wrote with my partner, Mr. Brent Kessler. It's a fantastic book. I want to mail this to a certain number of you, and it's going to be we'll get to who's going to get those. But on top of that, I'm going to include this, our quick start guide. Okay, so back years ago, we did this quick start guide, keeps things super duper simple. So I'm going to mail those to some select folks, but I'm going to give every one of you a white paper. Maybe not just one, but 2 white papers if you want, if you're really good, because remember, Santa Claus brings coal to the ones that are bad. Okay, so I'm going to assume all of you are good. Craig has some really amazing white papers based on what you're going to hear here, these 2 scenarios we're going to give you, and I want to give them to every single one of you. Craig, you want to tell them a little bit about that, just because I want to make sure that they know what they're all going to get if they've been good this year.
Sure. So instead of that coal in your sock, we're going to give you a couple PDF documents. One is a buy term invest the difference concept. And a lot of what Chris is going to talk about here is also in the document, so you can read it at your leisure, consume it. But it does talk about the impacts of sequence of returns, drawdown effects. And at the end of the day, what we did is we took a whole life policy, we invested in the same investment that you might take, a buy term invest the strategy, buy term and invest a different strategy with, and we just raced them. We just put them on a racetrack and we raced them, and you can see for yourself what happens over time, because we always want to break down our financial life cycle into multiple categories. There's the kind of the accumulation phase or the growth phase, and then there's distribution phase, right? We have to use that money for retirement, and then there's the legacy. And so all of those things need to work together. And a lot of times, what you're going to hear from the traditional financial advisors is, one little sliver of point in time of your life. So the buy term invest the difference is going to kind of give you that whole scope. And then we've got a retirement white paper, not written by us, but Chris did some videos about it. If you want to learn how to bring whole life into your retirement strategies, it kind of brings everything together in a big picture. If you have qualified funds, a whole life policy, so it brings a lot of options to you who are in retirement or nearing retirement and getting prepared for retirement.
All right, so we're going to give that to all of you in just a little bit. We're going to basically have you do something. It's nothing hard. You're just going to have to stand on your head for 15 minutes straight. You're going to then have to let your hands go up by your side, and if you fall, then we don't have to send it to you. So that's it.
Or 10
Okay.
push-ups.
Great, or 10 push-ups.
Yeah.
Sure. Or nothing, just stick around for a little bit. All right, let's get back to buy term, invest the difference. So this is a scenario coming straight out of that white paper that we talked about. And that white paper was written by someone very smart, not as smart as Craig, because he's really good in the sheets, the Excel sheets, but smart nonetheless. And they did this entire summary, and they proved something that to retirees had never been proved before. And that was how to reduce all of those risks that we talked about just a second ago. So let's just hit those real quick. Market volatility, longevity risk, taxes, sequence of return risks, healthcare risk, inflation risk, and debts. What if you could change one thing and add one step and reduce all of those risks or eliminate some of them? Well, here is somebody that does not, because they think they know what they don't know, and they're part of the buy term invest the difference club. So they've got a 401k. Their 401k has $2.5 million. They're 62 years old. And they got basically a stock portfolio of 60% stock, 40% bonds, and they're going to start distributing money. They also had a term policy for a 20-year term policy for $1 million. They bought term because it was cheap, and they said, oh, this is the greatest thing. It's going to give me 20 years, and in 20 years, I'm going to save up enough money where I'm never going to need life insurance. I'm self-insured. And they did it in a 401k. So in this scenario, pretty much all the risks apply to this person, every one of those risks. They didn't mitigate any of the risk, because in 20 years, which in this case, let's just say it's 62, let's say their term insurance ends then, they have no life insurance. So now, if that's okay, because they've saved $2.5 million, to which they're going to live off of, but when they start taking money out, they're going to take $80,000 per year, which, if you were in Dave Ramsey's magical mutual fund that gives you 12% every single year and never goes down in value, maybe this scenario would work. But since no one can seem to figure out where the hell to buy that damn mutual fund, that's not an option for any of us. Okay, we're not in the club, if you know what I mean. And that is the crazy club, the ultra crazy club, the Dave Ramsey crazy club. Yeah. So 60-40, 80,000 bucks. But 3 years into your retirement, all of a sudden the market takes a drop and it loses 20%. So when you took the $80,000, you're taking it from a portfolio that had dropped 20%. Right there, I don't need to say any more. You will not recover. Craig, could you pull up that slide real quick, that drawdown slide, so we can just kind of explain to them just a little bit about why? Because I can't just tell you that you're never going to recover from that, because you wouldn't believe me. But if we show it to you, then I think you will fully understand that this is absolutely the case. You can't recover. The drawdown is very difficult to beat. Go ahead, Craig.
So what we're talking about is in the market, if you're cruising along, now I know in Dave's magical 12%, he never has any downturns, but let's just assume that you're going along and you have a 10% loss. What does it require to get back to zero? Well, it requires an 11% gain. That could be next year, that could be 2 years from now, it could be further down the road. But as you see, as we get deeper into loss, a 20% loss requires a 25% gain just to get back to zero. A 30% loss requires a 43% gain just to get back to zero. And as you see, we keep going, and it just gets, I mean, if we're into the 40s and 50s, we need 67 to 100% gain just to get back to zero. That's the impact of the sequence of returns. So early in a retirement plan, if you start to have some lower returns or some losses, it's like throwing a bomb into your retirement plan, because you're not only withdrawing money, but you're withdrawing with a loss, which is then going to take you a lot more time to recover from that. And Chris, one of the things that these numbers don't show, taxes and fees.
Yep.
So if you were to put taxes and fees in the mix, let me just ask you, Chris, I know you were in the financial advisor world. If I'm your client and the market's going down and I'm losing money in my portfolio, are you still getting paid?
Absolutely.
Okay, so you're going to get paid regardless. So if we scroll down, and like I said, everyone can have this document, but if we start adding in taxes and fees, and there's some assumptions in here of taxes at 21% effective tax rates, but look at some of these numbers. If I have a 20% loss and I'm considering taxes and fees, I need a 36% gain. How achievable is that with, a quick turnaround? That's going to be painful.
It'd be tough.
So one of the things as we were doing this study, I'm showing in these graphs, if you have a 10%, dip, right in the next year, you have a 19% gain to get back to zero. If you have a 20% dip, you have a 36% gain to get back to zero. But in reality, does it always happen the next year? No. You
There
remember
it
the
is.
Great Depression? 25 years to recover. So what that means is it took the market 25 years to recover. Let's see, another example, October 19th, 1987, what they called Black Monday. It took about 2 years to recover. The global financial crisis in 2008 took about 5 years to recover. So the impact of what we're showing here is that these are the numbers it takes to get back, but it could take you 5 years, it could take you 2 years, it could take you 10 years, depending on what's going on in the market. So questions about that, let us know, but that's the impact of those sequence of returns.
So, Craig, with that, if I'm
Mhm.
picking up what you're putting down, you're basically just saying if somebody were in the stock market and and also too, it's kind of funny, Craig, I gotta tell you, I just Googled, because now with AI, it's pretty
Mhm.
smart. It's smarter than a PhD or a double MBA or anything like that. So I just put in there, Dave Ramsey's magical 12% mutual fund. And it said in the financial circles, the phrase Dave Ramsey's magical 12% mutual fund often refers to his claim that investors can achieve an average of annual return of 12% on their investments. Particularly through mutual funds, he often cites that the historical performance of the S&P 500 as a basis of his expectation. And so Dave Ramsey's not licensed as an advisor, nor am I anymore. I was, but he can say these things. An advisor would be, I don't even know what would happen if an advisor used that. But nonetheless, what he's referring to, because he does have some basis on this, is he's saying, all right, for example, the historical average return from 1928 to 2023 is 11.66%. That's where that's coming from. The historical average. So again, here's a trick, folks, and this is literally a myth that's real. Advisors, and Craig's going to show you this, advisors will often cite a historical return or an average return that a market or an index has performed at. And then in your mind, when you hear, oh, it's averaged 11.66, close enough, Dave's just rounding up, then I guess that's what I'm going to get. Craig, can you just show them? So, folks, listen, we do so much nerding out over here on the numbers, but Craig, tell them what this magical Excel spreadsheet you have here is, because this doesn't show 12% every single year. Now, maybe over a 100-year period or a 50-year period, it could be that, but ain't nobody got time for that.
So this magical spreadsheet is simply taking the returns from each year. This is the S&P 500, by the way, from 1928. I think I've got it all the way up to 2023. There's now new numbers. I need to update the sheet. But what it's looking at is what was the annual percentage of change of the S&P each year. So you see in 1928, we had a 37.88% positive, and then immediately we go into the Great Depression and we're now down 11, down 28, down 47, down 15, up 46, down 5. So there's this roller coaster, and what I could do is I could say, well, what was the annual average of the S&P from 1928 to 2023? Well, 7.86%. But what's going to happen if you're in this mix? Your
Oh,
average isn't.
no, actually, Craig, let me reinstate that. What's going to happen when you're in that period of time, and we can go down and look at any,
Mhm,
when you're taking distributions from your 401k?
mhm.
When you take the 80,000 you took out of the market because you had to live, but the market was down 11.91. The next year you took 80,000 out, and the market was down 28%. And then you took another 80 grand out when the market was down 47%. Remember those drawdown numbers? Craig, what was 30%? Wasn't it like 60 some percent or 40 some percent you needed to make back?
With taxes and fees, pretty darn close.
But I
Yeah.
mean, mutual funds have fees. Your advisor is going to charge you a fee for managing it. If you self-manage, you still have the mutual fund or ETF fee. So these are the things not factored into the myth that Dave Ramsey is saying you can get these kind of returns. It's just not going to happen for the average person. And we are tricked into believing that's the case, but it's just not. Thanks, Craig. Let me keep going with what we got
Okay.
over here because I want to show you all a very simple strategy. And this is in that white paper, just so you know, we're going to send this to every one of you. But this is called the covered asset strategy. Now, just imagine that same exact person that we talked about a second ago changes one thing, and instead of buying term, they put the money into a whole life policy. Now, in that white paper, I want to preface the whole life policy that they're putting the money into is a regular off-the-shelf whole life insurance policy. Nothing like the specially designed and engineered ones we do today and the ones that we would build private banking systems on. But that's all. So they buy $1 million whole life policy, $700,000 in cash value over the same period of time that we did that term insurance policy, which was 20 years. And then what we did is we only have $2 million in the 401k. But we take 300,000 of the 2 million. The day we want to retire, we take 300,000 of the 2 million and we switch it over into this vehicle called the SPIA, okay, a single premium immediate annuity. And the purpose of this particular vehicle is to provide a guaranteed yearly income or a guaranteed monthly paycheck. It never changes. It will be there for the rest of your life. Think of this as a personal pension plan. This vehicle will pay you the same payment for the rest of your life, no matter what the markets do, up, down, sideways, doesn't matter. The economy could tank out. It's going to pay out. That's what it's designed to do. So the reason we would put 300 of the 2 million into this is this particular person, let's just assume that their fixed expenses, their mortgage, their food, their entertainment, the things that they got to pay every single month cost them 30,000 bucks. So we want to guarantee 30,000. Now your number may be different than them. Yours could be 20 in fixed expenses. Yours might be 300,000 in fixed expenses. Listen, it just changes the numbers. That's all. In this scenario, in that white paper, 300 grand produced 30,000 of guaranteed income for the rest of their life. So we got 1.7 million, not 2.5 in the 401k. And now we're 62 years. Now what we're going to do is we're going to take an income. So for same thing before, but we're going to take 50 grand from the 401k. So now we're taking less money from the investment assets. So it's giving more of the investments time to grow, but we're guaranteeing 30. So 50, 60, 70, 80. So we're still getting $80,000, except for now 30,000 of the 80 is guaranteed. Now, remember before in that scenario, when we kind of went off on that thing that Craig showed, that market went down, right? And we showed you the markets can go down. So there was negative. That first person needed to take the $80,000 from their 401k, from their invested assets, because, well, that's all they had, because they bought term and invested the difference, one trick pony. Here, this particular client put the money into a whole life policy. In doing that, it costs them more money to put it into that whole life. However, the whole life built cash value. So by the numbers over that 20 years, this whole life policy has 700,000 in cash value. So when the market goes down and we need to take 50 grand out from the markets, we don't. We leave it alone because we don't want to take money out when the markets are down. That's going to have that drawdown effect. So what we're going to do is we're going to take a withdrawal or a loan, your choice, from the whole life policy, which the whole life policy has zero risk. It just goes up. It does nothing other than go up. Next year, you have more money than you did this year. The year after, you got more money than you did the prior year. Guaranteed growth. So it doesn't matter if the markets are down, doesn't matter how much they're down, we got the money. We cover our 401k assets by taking the income we need to live from this guaranteed bucket of money, which is a whole life insurance policy. And also, that whole life policy now has a death benefit that will never end for as long as you live. So now here's what we've guaranteed with just number 2, the covered asset strategy. We've guaranteed that we now have a place to take money when the markets are down, and you can't ever lose. Okay. We also guaranteed our fixed expenses at $30,000 so that we never have to worry about how we're going to pay our basic living expenses. And now what we also guaranteed is we guarantee that we don't need to take money from the 401k when the market's not at a good place to take the money. So we have covered our ass. Okay. Now we're just getting warmed up here. But how much better does that sound than the first one, right? It's the same dollars at work. So that's the other thing I didn't preface. The exact same dollars that we were talking about, and it's all in that white paper, to do this example, which was the 401k in the term, by term, invest the difference, $1,000 a year for the term, all the rest went into the 401k. We used the exact same dollars, but we shifted how they went in. And Dave Ramsey would say, oh, that was the dumbest thing ever. You would have had $500,000 more in that 401k if you just bought term, invest the difference, but we didn't. We spent more, we put more into a whole life policy because it had cash value. So now we got a death benefit that never ends. We got a cash flow that keeps going up that we can access to cover those down years. Now we never have to deal with the drawdown effect. We never have to worry about outliving our money because we guaranteed our money, and we guaranteed that we don't have to take money from the investment assets, so we can just let them grow and grow. And when things are good, guess what? We shift back over and we take money from the 401k. When things are bad, we shift over to this bucket. Pretty smart. Craig, anything you got to say to that before we move on?
No, I mean it's a safe strategy for using the same dollars, and the other thing I wanted to mention too is there's a taxable consequence on the 401k side where there isn't on the whole life side. With the big beautiful bill, there's some changes to how Social Security will get taxed, but prior to that, any of the 401k money could actually impact your Social Security taxes. It can impact your Medicare costs. Whereas when you're taking it from the whole life, you didn't have that. That income wasn't part of that calculation. So there's even a bigger benefit to taking it from the whole life in those cases.
Now there's some other things that we're going to hit because we haven't covered all of those risks. So we're going to go one more, and we're going to talk about what we call the pure volatility buffer strategy. That's a mouthful. So you can see we're just evolving here. All we're doing is we're just getting more and more efficient, but really all we're doing is we're changing little things to eliminate all those risks that I talked about that everybody said that they had. Okay? They're too late. They think they're too old to start. Okay? They need more income to make this work. I demonstrated you need the same amount of money. It's only for the wealthy. The markets always win in the long run, which they do not. We just proved that. And buy term, invest the difference is the best strategy. So here, pure volatility, here's what we're going to do now. Think of the exact same thing we did before. Same numbers. All these examples are the same client, same numbers, same scenarios. But what we're going to do here is now our 401k is going to have 200 or 2 million, just like the other one. We're going to take 300,000 out, put it into that SPIA to provide that guaranteed income. So now we got 1.7 left in the market. But now what we're going to do with this one is now we're going to use this whole life. Okay, so now we've got this whole life policy, and it's got a little bit more money. And because what we did is now when we're not needing the money in the SPIA, we're going to move some of that income into the whole life. We're going to continue funding that whole life. So the one I just showed you, and I forgot to mention this, with the whole life, that whole life was a limited pay. We stopped funding that whole life at the time of retirement, so we were putting no more money in it. Now what we're going to do in this scenario, the pure volatility, we're just going to continue funding that whole life. So now it's going to have more cash value over time. But we still have enough money to take out. All we did is we protected one more thing, and that was we protected future growth of that whole life. That's it. So we're doing the same thing as before, except for now we're just adding one additional step, and that is taking the income that we're not using and putting it back into the whole life, continuing to use that whole life into the future to make more and more money. Because the goal is, what I'm trying to do is, and you're going to see that in a second, is I'm trying to get it so that you every year are taking more money out of your retirement and not jeopardizing your 401k when markets are down. So we just want to give you a raise. That's all. And we start putting some of those numbers together right here in the combo strategy, which is covered asset plus pure volatility. 401k had 2 million, 300 went to the SPIA We had the whole life, which we continued funding. But now what we could do here, remember I said there was another example where the person goes into retirement with debt. So now all we're going to do is we're going to start using the whole life policy to do things like pay off debt. So when the market's going up and the markets are doing well, we take the money from the 401k to live on plus the SPIA. The whole life, what we do with that is we invest that money. Over here, this is the infinite banking concept. So I did an example of a car. Even in retirement, folks are going to need cars. And they're going to buy cars one of four ways. They're going to pay cash for it. Okay, they're going to take a loan, they're going to lease it, or they're going to steal it. So here, what I'm going to do is I'm going to show, instead of buying a car the traditional way, what we're going to do is we're going to take a loan from our whole life insurance policy for 60 grand. We're going to buy the car. We're going to make the same car payment. So in this example, I don't know, 800 bucks a month is a pretty nice car for 60 grand. We're going to take the $800 and we're going to put it back into the policy. Now remember, who's paying the $800? Well, that's coming out of the SPIA because that's one of your fixed expenses. So all we're now doing is we're using the whole life in the years where we don't need it for retirement to fund the things in life that we need. So now, instead of losing that money and giving away that car payment and not getting that money as part of your plan, it's just an expense. Now your expenses become assets. Your liabilities become assets when you become the bank. So all we're doing is we're just showing this cycle. So this would be like putting your retirement on a boat with rockets. I don't know, I just got crazy with that. So now we could use it for, instead of building debts, like having car loans or credit cards, we're using our policy, that whole life policy, we're using it to fund our big purchases, our cars, maybe you need a new fridge, you need something, anything you would finance, you would use the policy. And all that's doing is helping your retirement, because now that money you used to give away is now income that you get to use, to live on. So as we keep going, and I keep showing this, and again, I got a white paper on this. This is the combo number 2. It's the volatility buffer plus covered asset strategy. But now what we're going to do is, instead of using the whole life policy to buy just cars, we're going to take the money in the whole life when we don't need it to fund our retirement, and we're going to lend that money out. We're going to be the bank. We're going to lend it out on a thing called private money club. Okay, and that may or may not be within the things you want to do, but if you did, now we get that money to go out and make 12% lent on a piece of real estate in a first lien position. So now that 12% income that comes back, it's not that magical mutual fund Dave Ramsey talks about, but it's pretty, not too shabby. It's got a asset that protects it in a first lien position. So now what we're doing is we're juicing our income yet again, but none of the dollars have changed. Still the 1.7 million in the 401k, still the 750,000 in the whole life, still the 300 in the SPIA. Nothing changed except for how we make our money work for us. So as we just keep going through each of these examples, what we're effectively doing is we're cutting down the risks that we had in the 401k. We're adding additional income by making our money work for us. And I know there's a lot of writing on here. We did a whole training on this, and I'm not doing that today. But I'm just going to come back to why we did this, because some of you just heard a lot and you're like, holy cow, that's a lot of info. Well, don't worry. We're going to give you the white paper. We took care of market volatility, did we not? Craig, remember the market volatility we talked about in the first one? We couldn't really avoid that. But in the second and on, we had a volatility buffer. We had a covered asset that could make sure that we could take money out. So it didn't matter if the markets went down. We were never using the money from the markets when they were down, only when they were advantageous for us to take money. Longevity risk. Well, we provided the ability for you to never outlive your money because we guaranteed your fixed expenses with that SPIA, and we put money into that stupid whole life policy that only did one thing, and that was go up, never goes down. And then we let our market-based investments go up. The taxes, we were able to reduce taxes because that whole life policy is tax-free. And when we don't take money from the 401k outside of RMDs, we don't have to pay tax on as much money. Remember the first strategy, we're taking 80,000 bucks from the 401k, the buy term invest difference. That means $80,000, if it's not a Roth, is taxable. But remember, in the second one, we were only taking 50,000 from the 401k. So we reduced our taxes. Yes, the SPIA is taxed, but it's slightly different taxation than the 401k. Your 401k is 100% taxed. The SPIA, well, actually, I misspoke. The SPIA would be the same taxation. So your taxation on the SPIA and the 401k would be identical, but the income that we take from the whole life policy, tax-free, okay? And then down here, sequence of returns. We don't give a shit what the sequence of returns are. It doesn't matter what the returns are or when they come or that, because we've got options for how we're going to take our income. Healthcare risk, well, we didn't really get into that in this one, okay? But you could get sick and that, but here we get at least guaranteed a portion of your income. Inflation risk, well, inflation risk is that your money doesn't grow at a pace fast enough to outpace inflation. So if inflation right now, let's just round it up to 3%, you got to make more than 3. Well, the SPIA is paying you out more than 3. The 401k over the long haul is making more than 3. And the whole life policy is making more than 3. So we're beating inflation. And then the debts. The only option was the combo option that allowed us to use that policy and use the infinite banking concept to pay our debts off while we're still getting into retirement. So again, I didn't go deep into that, but again, that's in the white paper and it's also in a video that we can give you. So Craig, with that, I just went on a little bit of a tangent there. Let's go back over to your stuff and let's show them some of the ways that we can kind of mitigate some of those risks. And before we do that, actually, Stephen, do we have any questions that we need to answer?
Yeah, man, we're rolling. It's good stuff. So how can I use this process with a private foundation and not make any taxable event?
All right, so I could definitely speak on this. So a little different. So folks, we're going to come over here. How can I use this strategy with a private foundation? So I have a private foundation. Okay, so let's just think of this. It's private, so basically we don't have any reporting outside of tax returns. And it's also just for our use. So how this works is I take income that I make, and it doesn't matter if it's W-2, 1099, K-1, and I basically take a percentage. I can do up to 50% of my income, and I can put it into the private foundation, for which I receive a taxable deduction, okay? So that's one of the reasons that people do a foundation or what we would call a 501c3, a nonprofit private foundation. I can put money into my private foundation, and for that money, I get a deduction. So let's say I'm at tax rates just changed, but I'm at the highest. So let's call it 37 plus state tax. So 37 plus 9. I think that's my state tax, 9. Stephen, you wouldn't know a thing or two about that, but I get a deduction for whatever I put into the foundation. So let's just say I put $50,000 into my private foundation. That's $50,000 I can take as a deduction against my taxes at my current tax rate. Not too shabby. Then I am required to at least donate or give to charitable causes 5% per year. I do way more than that, but that's just the requirement. So that's kind of how the private foundation works. Now, what you were asking is, give me the question again, Stephen, now that I laid that. I just had to bring people up to what a private foundation is. What was the question again?
Just how can I use this process with a private foundation and not make any taxable event?
Not make it a taxable event. So, well, the private foundation, you could take some of the money you're putting into the private foundation. You could set up a whole life owned by the private foundation. So the whole life is going to build cash value, and it's also going to have death benefit. You can't personally benefit from this. I want to be clear, but you could take the cash value from the whole life and you could invest that cash value, just like you could invest any assets of your 501c3, your private foundation. So I could invest them in real estate for the benefit of the foundation. I want to be clear about that. So I can invest that in real estate. I can take the earnings of the real estate, roll it back into the whole life, and keep doing that. So using the IBC, I could do all of that. And then here's what's going to happen. Someday I'm going to die. The death benefit is then going to be paid back to the private foundation so that my daughter or your son or anyone in your family is going to now have a lot more money to go out there in the world and do good. And we have not created any taxation here. Matter of fact, all we did is created a mechanism to provide a tax deduction. Because the dollars that go into the private foundation are the same dollars you're using to fund the premium deposits of this whole life. This whole life is then being used to invest money within the foundation to make more money for the foundation. The only way you could benefit from the foundation, number one, is your tax deduction. And number two, you could take and there's some rules, but you could take a salary, a reasonable salary from your private foundation for running it. So you can dive more into that, get a good attorney that understands that, but that's how you would use a private foundation to do kind of what we talked about. But this would not help you for retirement. well, the salary might, but none of this would really help you for anything other than tax deductions, the ability to donate charity, and if you're running it and you can prove that you're running it, you can take a salary from it. All right, what else we got?
Can my revocable trust be the owner of my IBC whole life policy with me being the beneficiary of the trust? My
Revocable
trustee,
trust or
revocable,
irrevocable?
revocable.
Yeah. Yeah, it's a revocable trust. Sure. A
My
revocable
trustee needs
trust.
to know this because this is the only way he'll approve my funds from my trust to be used in funding my policy and or to fund my real estate deals.
I mean, a revocable trust really doesn't provide asset protection. So it's really just giving you, like, it allows you to bypass probate, which the policy would anyway. But it gives you a little bit of, I guess there's some benefit there. So with $10,000 deductible, like a house, 1.9, yeah, I don't know what that is. But anyway, yes, you could use a revocable trust.
Tell me about the new program where interest is deductible for an American-made car loan with up to 10,000 deductible like a house and a 1.9% interest. Seems to be an opportunity to buy a new car, even beating the arbitrage of 5.7% loan from a life insurance policy. Am I missing something perhaps?
I don't know. We haven't done any videos on it. The big beautiful tax bill just went out, but as of now, yes, that is one of the things we can do is you can deduct up to $10,000 of interest payments annually. Now, here's the crappy thing. And I went on a rant this morning in WTF. Like, everybody says that the new tax bill is only for the wealthy. So if this tax bill was built for the wealthy, then how come that particular deduction to get $10,000 per year of interest deductions on your cars phases out when someone makes a joint filer makes 200,000? That's it. That's the only downside. So there's an income limitation. So if you make over 200,000 jointly or over 100,000 single, you're phased out. The deduction starts to phase out on modified gross income. Now, there's some unique ways around that, but so go back to what you're saying. Yes, for what we do in the arbitrage and the spreads that we always talk about, the fact that now you can take a deduction of the interest, and we'd want to consult with a CPA, and same thing with that trust question, I would always advise you consult with your attorney and get legal advice on that, and also consult with your CPA. But revocable trusts are pretty easy, and I do understand them because I have one. But for this income deduction, or this interest deduction, this is something we haven't wrapped our head around yet, but I want to just put out an idea, Craig. I think one thing that would be cool is to run some numbers showing this. You know, assuming that somebody's making less than 100 or 200,000 in the phase out, so that we can get that deduction. So we roll that into that spread using the policies and the infinite banking concept to fund our vehicles. But the interest, now this is where it might get sticky because I don't know if there's self-dealing rules and it's a bit early to tell, but could we take that deduction like they're allowing in the big beautiful tax bill? Could we take that deduction even though we're paying the interest back to our private banking system? And then if they said no, if it's the policy's owned by you and you're benefiting, you can't, then, well, if let's just assume, if a trust owned it or if an entity owned it, then the interest from that, if it went back into the entity, could that be deductible? So there's lots of things we got to answer, but I like where your head's at. I do. What else we got?
Is it wise to take a policy loan to pay taxes on a Roth conversion?
I can't see why not. I'd have to say that's Mark, right? I'd have to run the math on that. So I know a guy that's good in the sheets, and I think we could run the math on that. But we in the past had done something very similar where someone had started policies. They used the policies to finance their property taxes every year, and they just kept rolling it. And all they did is over time, they just made that spread. So it was just more advantageous for them to do it that way. So I can't see why your scenario would be any different.
Yeah, and I think it goes to say anytime you're using policies to pay off maybe a tax bill or something else, you always want to think about how is your cash flow going to come back into the policy? Because we do want to cover at least the loan interest. So I think it's a good idea as long as you have a way to repay the policy loan interest.
I got to go to one other thing. There's been a bunch of questions that came up about that, the interest. So one of the things, and I didn't read through the whole thing, that it's mandated for that is the car must be manufactured in the USA, I believe. So if all of you could do me a solid, grab a pen and paper or type this up, type a letter to Porsche. And I would like you to ask Porsche to please build a manufacturing facility in the United States of America. I'm totally joking, but listen, like, I think it says that the car has to be assembled in the United States of America. to which now Toyotas are assembled here, Hondas are assembled here. I can keep going, but we'll just use those two big ones. And remember, they never used to be prior to the United States of America slapping massive tariffs on Japan when they were sending all their cars here in the 80s. So Japan, in retaliation of those big tariffs, said, fine, we'll just build plants in the United States of America, make our cars and assemble them in the US, and you guys will be happy. So listen, it's a unique thing. The car must be assembled in the United States of America. With these tariffs and all these things, when the dust finally settles of the craziness with them, I beg to ask you, how many of the cars that are not manufactured in the US will be? Will Audis be made here? Will Volkswagens be made here? Will Lamborghinis be made here? Porsches be made here? Will all those cars that are not made in the US be made here in the near future? If I have to look back as history as my guidance, I would say yes. But for now, go out and get yourself one of those Raptors. Go out and get yourself one of those brand new awesome F-150s or the 1500 Chevys. They're all great cars assembled in the United States.
Cool. And I have a lot of people asking about trust and foundations and tax strategies. And should I use an LLC? And do I need a company for investing? And the answer to that, all of that is absolutely yes. We have a really good referral partner that we can, I would highly recommend you guys contact for help with that stuff. I'll put them over in the chat box. By the name of Corporate Capital, a guy named Brent Carlson. So reach out to them. They will go through your situation, what you got going on. They're very familiar with everything we do, from self-directed IRAs to real estate investing to infinite banking and everything in between. So reach out to them. They'll help you with all that.
I love Moses. Moses says he's going to get himself a Rolls Royce. Now listen, like, for any of you car people, there is no car that is better manufactured than a Rolls Royce. It is literally, sincerely, probably the only car that you could buy, and it'd be the only car you'd ever need to buy. But anyway, great choice of cars, Moses. I can't afford one of those yet.
All right, keep rolling.
All right.
Yeah, and there's one other question that came through. I answered a few of them, but I think many people might have the same one. But the question was, what is an SPIA?
Yes. All right. Well, let's do two things, Craig. A SPIA is a single premium immediate annuity. So how they operate, they're not complicated at all. They can be, but let's just say you've got a windfall of money. You've got $100,000, and it doesn't matter. Let's say this is in a old 401k. You could roll that $100,000 into an annuity, and this is called, it goes by a couple names, GLI, but we'll call it a SPIA, single premium immediate annuity. And it's just like it sounds. It's a single premium, meaning we're moving 100,000 in all in one shot. And if it's a 401k, just so you know, this is considered a qualified rollover, which means no taxes or penalties. Okay, it's qualified. So now the money is sitting in a qualified SPIA, single premium, the 100 grand, immediate annuity. Now the immediate stands for what we're going to do is this immediate annuity immediately is going to kick out an income. So you can sometimes defer that income for like 6 months, maybe 12 months in some of them. But for the most part, you have to think if you put 100 grand in the next month, you're going to start getting an income check coming out of this thing. And what's really cool about single premium immediate annuities is it's not just an interest rate. So a lot of people are so used to, okay, well, what's my interest rate? Great. All right. The single premium immediate annuity might pay you 5%. But you see, your payout rate is significantly more than 5% because it's based on your longevity, okay? Your mortality. That's why an insurance company is the only one that can do an annuity, because an annuity is based on your longevity. So let's just say that somebody's 60 years old. At 60, the mortality tables are going to probably show that you're going to have a strong probability of living to like 85 years old. So what the insurance company does is they calculate from 60 to 85, that's 25 years. So they're on the hook for 25 years of paying you income. They basically told you in the contract that they're going to give you 5%, but you see, you're going to make probably more like 7 or 8% on this as a payout rate because you're going to get some mortality credits. And the mortality credits are based on your age. If you were 65, it's only 20 years they've got to pay out. So now your income would have gone up. If you were 70, if you're 70, now the insurance company's looking at being like, damn, we only got to pay this person 15 years. The money's going to be making 5%, but we're going to give them mortality credits because now we are only on the hook for 15 years. So they're going to repay all the 100 because it's guaranteed. They're going to give you 5% Plus, they're going to give you mortality credits. Craig, do you have that slide on SPIAs that we could maybe show them kind of how they work?
Yeah, I do. And one of the
Let's talk
things I
about
think
that
to
for a
mention
second.
here too is what you're kind of illustrating is a lifetime income. So you can have a lifetime income, which is great for that covered asset strategy we just talked about. But you may want to set it up where it pays out for 10 years where we can run that into a policy. So that there's a lot of different ways to run that income. And what we'll show you now is an example of funding a policy with a SPIA.
And this is a really good question because a lot of people don't know about these vehicles. They're boring, but they are very effective.
Oh, and one thing for everybody on the call today, you can always
Oh, we
go
gonna
out
give
to
them their
the,
free stuff?
what's that?
We're gonna give them their free stuff?
Um, well, this is that in-depth, video you did is an hour and a half, yeah, hour and 40 minutes. If anyone wants to go back and review the details and the numbers, scan this QR code, take a picture of this, but that'll take you right to that wealth webinar where Chris went deep dive on the volatility buffer of the covered asset. We're skimming the surface in it today, but if you want to go into the great details, go there. And in a moment, we'll share out the white paper. Does everybody have that? Going once, going twice, gone. Okay, so let's talk about the use of a single premium immediate annuity. And essentially what we're going to do, and just like Chris was saying, if you have, maybe you've got a qualified account, it could be, you're now at retirement, you want to take some of that money and put it into a single premium immediate annuity. Just by moving that qualified money from one bucket to the next, it doesn't cause any sort of taxable situation. There are qualified annuities and there's non-qualified annuities. So just know that if you do have some 401k money, IRA money, you can put it into a single premium immediate annuity without tax consequences. Now, when you get the income from that, that's when you get the taxes. So one of the strategies that Chris was sharing was to take some of those retirement funds, put them into a single premium immediate annuity. That could be called a covered asset. So it's going to create the income you need for the basic expenses. What we're showing here is actually putting that chunk of money into the annuity, having it kick off about $11,000 a year. And then what we're going to do is pay some of the taxes. So we do a one-time funding, $100,000. It creates this single premium immediate annuity. It creates a yearly distribution of about 11,546.
Let's
And we
hold on,
did this,
hold on 1 second there, Craig, because I want to just explain the payout rate.
sure.
So let's just say this annuity, and I'm just going to make numbers up, but let's just say this annuity in the contract said that we were going to get a 5% interest rate. If any of you just did the math, you put 100 grand in, and every year it's going to pay you out 11,546. So effectively, if you just did the math, 11,546.62 divided into 100, that's an 11.5% payout rate. But the factor here that you wouldn't be factoring with that is that this is a 10 pay. So that's also built into it.
Mhm.
So you're effectively making 11.5% on your money over those 10 years. And then it's done after the 10th year. Sorry, I didn't mean to interrupt.
No, I mean, it's a really, really important point because this was set up with a guaranteed period of 10 years. You can make them 20 years, you can make them lifetime, but we're using this in a strategy where we want to kind of funnel some of that money out of the qualified account into a whole life policy that converts that, now we have that tax-free growth. We also have tax advantage growth, I should say, and we also have the ability to transfer that death benefit without taxes. So we're trickling out some of that taxable money, getting it into a different environment where we can use it in a tax-free environment, tax-favored environment, and also pass on legacy without taxes. So essentially what we're doing is we're taking that lump sum, taking the 11,546 every year, paying some taxes, and putting the rest into a 10-pay whole life policy, which means we're only paying premiums for 10 years and then we're done. We now have a paid up policy. So that's step one. And what this looks like is if you're putting in $11,000 of premium. So if we look down this column, we have 10 years of $11,000 premiums. And if we look at this projected cash value at the end of that 10 years, we've now essentially converted that income from the qualified account to the whole life policy, and we have about $124,000 of tax-free, money to use for retirement or whatever you want to do. And we also have a death benefit of 362. So that's just one strategy of using some of that qualified money in the qualified single premium immediate annuity, trickle it out into a whole life policy. So that would
Yeah,
be a
love that.
strategy.
You end up making more money. You got the protection on the back end to make sure that, whenever you pass, the money is paid out tax-free to your beneficiaries, which would kind of refill the bucket of money that you went through using the 10-year SPIA. So it's a fantastic strategy. When I was an advisor, we did lots of this, and we did this for all sorts of people, but it's a bulletproof 100% guaranteed option.
Yep.
That's what I like about it.
Yep. So we do get some questions about, well, hey, what would happen, Chris, if I just took that 100,000 and I put it into a single premium whole life policy? So I skip the annuity and I just put that 100,000 right into a single premium whole life policy. Well, for those that are new to this, what it will do is it will create what's called a modified endowment contract. The policy will be a taxable entity at that point. Now, the crowd doesn't like to hear a taxable entity. However, let's really look at this. So when we trickled that money out through the single premium immediate annuity, we still paid some taxes every year from the distributions, but we had about 124,000 of cash value. But look what happens if we put that 100,000 into a single premium whole life policy. Yes, it will be taxes above the cost or any gains above the cost basis, which means if I've put in 200,000, if I put in 100,000, that's my cost basis. Anything above that is taxed. Okay. So at end of year 10, we have 142,000 of cash value compared to the 124 we had before. However, everything above our 100 is taxable. So just assuming that at year 10, if we were to withdraw, which we're not going to want to do it that way, but if we did, we'd have a taxable gain on that 42,000. An effective tax rate of 25% is going to mean we pay 10,517 in taxes. And essentially what we're left with is a net benefit of 128,000. So we're still ahead of the single premium immediate annuity. We're not saying that this one's better or that one's better. We're just simply saying, based on your specific situation and what you're trying to accomplish, there's different ways of building out the next step. You might want to do it through an immediate annuity. You might want to do it with a single premium whole life policy. And again, these are all retirement strategies. Now we have that 142 we can use for supplemental retirement income. Anything you want to add to that, Chris?
No, I love it. I'm just hitting some of the questions that people are asking. How old, because we had that question always comes up. I'm too old, like with the SPIAs. I mean, it depends on the company, and I was just looking through a few of the ones we work with, but like anywhere between 75 and 95 years old, we can go up to with those. It's just carrier specific.
Yep. And this kind of goes down a different path, but one of the things to think about in terms of single premium whole life policies is if you have an old policy and you're just going to do a 1035 of all the cash value into a new policy, you can do a single premium whole life and it's not a modified endowment contract as long as you add no more new money to it. So that could be a strategy if you've got a whole life policy that's not really what you want. I'd be leery of just doing a 1035 on an old policy. That's where we really need to be careful and just look at that policy. But that is a strategy that sometimes gets used.
Well, let's take a second while we've got 192 people here, and let's give them, some real value added stuff. So remember in the beginning, we named a couple things that you all were going to be able to get. So first and foremost, I want to make sure that every one of you have the ability to get the white paper. There's 2 white papers, okay? The first white paper that we talked about was the volatility buffer strategy. That was this one here where we talked about over here. So Craig, how would they go about getting that volatility buffer strategy white paper? So real quick, we're going to put it in the chat. We're going to give you the volatility buffer. Now, this is not written by Craig or I. We didn't write this, but we based that whole video that he put the QR code up on that. It's a fantastic read. There's multiple strategies and scenarios in there, but if any of you are in retirement right now, concerned about any of these risks that we talked about and wondering how to mitigate them, you're going to love this. If any of you are close to retirement and wondering, how do I get prepared, this is going to be a great white paper. And for all the rest of you that are kind of early stage or saving for retirement, this is how you'd want to bulletproof your retirement to make sure that nothing that could happen, but outside of that, that would take care of most of the risks. Now, the other white paper outside of the one that Craig just put up there that we said we'd give you is one that Craig did write. And me and Craig, gosh, we went back and forth for a while on this, a huge project. And the project started because we were challenged. We had 2 financial advisors do a video saying how IBC is a terrible place to put the money, buy term invest the difference is better. And we said, you're wrong, and we will prove it. And we did, and then they never had us come on the podcast. You know, it's just so rude how they did that, right, Craig? Like, we put all this work in, we proved them wrong mathematically, every scenario, sent it to them, and they didn't have us back on. But we'll give you that buy term invest the difference white paper. If you still think buy term invest the difference is the way to go, this white paper will prove to you mathematically that it is not. So it is the first of its kind, but there's the link for the buy term invest the difference. Now, the last one I want to do while we still got Steven here, because he's got to leave at 2:30, is I've got the quick start guide, okay, which is the IBC quick start guide. And I've got my book, Mapping Out the Millionaire Mystery. So now some of you, based on the questions I've been hitting and Steven's been hitting, you're going to want to set up a call with us. You're going to want to do a strategy call with us to find out like what one of these strategies might work for me. And the best way for us to do that is to book a call. So we're going to put up a link over on the chat right now where you can book a call with our mentors. And during that call, what we're going to do is we're going to find out what your needs and goals are. What is it that you want to solve? You know, are you thinking about doing a trust? You want the trust to own the policy. You're looking at buying cars, paying off debt, investing in real estate, doing all these different things, but you want a better way to do it. Remember, the biggest problem in America is not what people don't know. It's what they think they know that just ain't so. So we want to show you what you don't know and a more efficient way to do this. So if you book a call using this link today, I want you personally, and Shauna's going to make me do this. She's going to be like, hey, you did this on your own. I will personally mail you the quick start guide and Mapping Out the Millionaire Mystery. So here's all you need to do. And Craig, can you type this in the chat for me? If you book a call today, all I want you to do is send me an email as well. My email is chris@themoneymultiplier.com. And all I want in the email and the memo just said, I booked a call. That means I will know what to mail you, and then give me your address. That's all I need. I booked a call in the memo and your address to chris@themoneymultiplier. This is only for people that have booked a call. So when I get those emails, what I'm going to do is I'm going to compile the names. I'm going to send them off to Steven. I'm going to say, did these people book a call? So I'm going to hold you accountable because that's important in life today. You can't just say something and not do it. All the politicians do that, but you're not going to be that person. So if you booked a call, I'm going to mail you these things. And I got one last thing. We haven't done this in a long time, but I figured since Steven, for the first time ever, doesn't have his hat on, I'd like to show this to everybody. We came up with these limited edition hats. I'm not trying to sell you something here, but people ask all the time. We literally had, well, we don't have 180. We probably have 100 of these hats left. If any of you take advantage of buying one of these hats, they're $37. We ship them for free. You basically will just come in, you'll complete this, and then we will mail you one of these hats. If you buy a hat, I will also mail you the Quick Start Guide and Mapping Out the Millionaire Mystery. So I'm going to give you this link right now. You got a bunch of options and a bunch of ways to get some free stuff. You can either buy a hat, okay, and that's great. You got something to cover your lid. You could book a call, and then the other two, the white papers, we're just going to give them to you. So where do you want to go from here? You want to answer some questions? Steven, can we rapid fire through some of these questions in the Q&A?
Yeah, keep them coming too, guys. Marita's just super excited to be here. Perfect topic right now. It's funny how things always happen for a reason, right? But such a blessing from God. Amen there. Drew said, for the annuity, can you move money from an IRA into this such that it could pay out each year? Could happen before 59.5 without having the 10% penalty?
Okay, so that's a good question. So Drew's asking, if you had money in an IRA and you put it into the annuity, could you take the money out and bypass the 10% penalty? No. No, if it's qualified money, if it's an IRA, it's still gonna fall under those rules. And really quick, also, Craig, could you do us a solid while we're answering these? Could you just take, people are asking, how do I get all the white papers? Can you just consolidate all the links for the white papers, put them in one chat, and then also the book a call and the hat one in another one?
Yeah. Johnny was just asking, what is the rate of return on whole life?
Well, it depends on so there's the rate of return. There's several different ways you could factor that. And I've done a whole bunch of videos on this. There's cash on cash return, which is your yearly return on your premium deposit you put in that year. There's cumulative return, which is I put money in the policy and I put it in there for 5 years. What is my cumulative return? So total premium and then the cash value, and you divide out the two, that's your cumulative return. Or some people just say, what are the insurance companies paying me? Which is the dividend crediting rate. So the dividend crediting rate for the carriers that we deal with is anywhere between, like the one we just were out with is 5.75%. That's their dividend crediting rate. Okay, then another one we deal with is 5.9 or 6%. And then the highest is Mass at 6.4%. But just because it's got the highest dividend crediting rate does not mean it has the highest returns. There's some internal factors that you have to figure. So, but those are the dividend crediting rates that the insurance companies pay out to, on the cash value in the policies. So again, those are just different returns. I don't know specifically which one you were looking at. And just, Johnny, just so you know, like the rate of return would vary too in investments depending on how you were looking at it and the time frame. And there's never just one return. There's always like, there's an average return, there's a cumulative return, a cash on cash return.
Cool. So with SPIA, there's no death benefit, but can provide income in retirement, but still grows over time.
That's correct. So the biggest guarantee in the SPIAs is, number one, the income payment you're getting, but number two, the guarantee that you'll never ever not get all your principal back. So if you got into, let's just say, a SPIA that was for your whole life and you died early, you'd have an option that you could pick where they would pay out the total amount that you put in and then plus all the interest that you were paid on those years you got it. So it's not a death benefit though.
All right, that looks like the questions right now.
Awesome. And that gave Craig time to put that in. So hopefully that's helpful, folks. Kind of gives you the white papers, the buy term invest the difference white paper and the volatility buffer white paper. And then you book a call, you get these, you just got to email me. Remember that. So if you book a call, you got to send an email to chris@themoneymultiplier.com and just book a call and then name and address. Otherwise I don't know where to mail it. And if you buy a hat, same thing, email me, say, hey, Chris, I bought a hat.
Yeah.
Advice for my 18-year-old daughter. Gosh, I have an 18-year-old, but I have a 5-year-old, and I just tell her you can do anything you want and be anything you want. You just have to solve other people's problems. So I'll give you the same advice I do my daughter is tell your daughter to be grateful and to give as much as possible, and then she will get everything she wants the more she gives. Yeah, I love that. Tess said, all the goodies are great, but the call is life-changing. Exactly. But sometimes you got to give people a carrot or two. It's the old carrot on a stick, right? We'll give you the carrot, but you got to walk. You got to walk the walk because action is the real defining differentiator. It's great that you learn. It's great that you learn new things, get the value from all this knowledge. But until you take action, nothing in your life will change. So well said, Tess. Oh, Mark Perry's asking for MSTV. So folks, we got this other thing that we never get a chance to talk about called MSTV. It's Money School TV. We created it in 2020. It's been kind of the backbone for all the companies. And what it is, it's just it's just all of our education. We do live webinars on there. They're only available to paying members. It's $19 a month or $190 a year. We'll put the link up in there. Lose all my money for lack of information. True, but I lose all my money for lack of information. Yeah, it's a combination of the two, right? It's effort and energy you put in, but it's also the information that you apply. So no one ever said getting wealthy or putting yourself in a better financial position was easy, but it's possible. And I think that's the most important thing. You got to have a little faith. You got to believe in yourself. That's the most important thing. And you got to change what you're doing. You got to change the way you use money, and you got to change the way you think about money. The biggest mistake I see people do is a limiting belief about money. They believe that because they were born into a specific situation that they can't have the things, they'll never have the cars, the houses, and the things that they want because they were born into a specific situation. Well, watch Pursuit of Happiness if you need some motivation, but that isn't the case. Every single person has the ability to do and be who they want to, but they got to believe in it. They got to have a worthy idea that solves somebody else's problem, and they got to work toward it consistently and persistently. And if you want more advice on how to obtain that, just listen to Earl Nightingale. Honestly, like that's the secret right there. And that's what the thing's called.
Yeah, this was great, guys. This was awesome. Georgia, I have cash, self-directed IRA. I'm selling a house this month to an investor. Awesome. Yeah, get that money working for you. Get it through a policy. Let's get it, maybe check out Private Money Club if you're looking for a place to do some lending. But yeah, lots of options there, Georgia. Very cool. Thanks, guys.
All right. Thanks, Stephen.
Thanks, Georgia. I just gave you the link to book a call. Sounds like we need to get on a call and talk. And, a lot of people I know, they're like, oh, I don't want to get on a call. I just want this. But listen, we need to understand what your needs and goals are. We have to understand what problem we're solving. We're not magic workers. I mean, this is a concept, but it's a concept that solves a problem. So if we don't know the problem we're solving, we're literally just selling you a product, and that's not what we do. We are in the business of using a concept, a strategy to then solve a problem. The product, okay, that everybody the tangible thing that people wrap their head around is the specially designed whole life. That just makes it more efficient. That is all. Okay, I don't want to glorify or vilify the whole life. I just want you to know that all it's designed to do is make the process more efficient because of compounding interest, uninterrupted compounding interest, and some tax advantages and other things. And also, I'm sure many of you have kids and you have a family. Why not leave your family in a better place when you're gone? And, I always tell people, I say, there are some people we cannot help. And I'll tell you the person we can't help. It's the person that calls us, gets on a phone and says, I don't need any death benefit. I don't want to leave anything to my family. That is an instant disqualification. I don't care how much money you have. You're going to give up $10 million. I got $10 million I want to give you. I don't want it because your head's on wrong. Your priorities are screwed up. Your ethics are out of place and they're not aligned with what we do. Therefore, I don't care how much money that person would have. If they don't align with our values and our views and our ethics, then it doesn't matter. It's just money can't make you happy and money can't solve a problem if your priorities are out of place. So at the end of the day, I'll wrap on this. The death benefit, the thing we talk about the least, is the most important thing, because that death benefit, when any of us die, that death benefit will be the only thing that matters. It won't be the cash value or the return or the cash on cash return or the uninterrupted compounding interest or the volatility buffer. It won't be any of that. It will be the fact that you left a legacy and you left your family, your loved ones in a better place. I know this to be fact. I know this to be a certain because I have delivered more death benefits than any of you on here, probably even combined. I've been doing this 22 years. I've delivered a lot of death benefits, and I will tell you, there's never been a time that I have brought a check that has not been impactful for that family. Matter of fact, there's never been a time that I've brought a check where the family has said, oh, no, we don't want that. No. Silly. We didn't want life insurance. Like, well, did he buy life insurance? Really? Well, we don't want the death benefit. Like, never would that happen. It's always usually handled with crying and hugging and a sense of relief because we're the only ones that are bringing a check. See, at that time when we lose a loved one, everybody's got their hand out. Everybody's handing you an invoice. Everybody wants you to write them a check. The funeral, the flowers, everything. Everything costs money. But there are a lot of families that, unfortunately, when they lose the loved one, they literally have to pool money together. They have to go out there, or they have to sell things just to be able to bury a loved one. Please don't let that be you. And you know what? If you have children, the greatest gift you can ever give your child is give them a policy when they're young. If you look at the policies I've done for my daughter, you look at the policies some of you have, how much they have grown over those years. And it's so little does so much because you got time value of money and compounding effect. Those are incredibly powerful. But with that being said, folks, thank you all for being here. 160, almost 170 of you made it to the end. So I hope all of you take advantage of the white papers that we've going to give you. For those of you that buy a hat or book a call, I'm going to personally, because Sean is going to make me, mail you out Mapping Out the Millionaire Mystery and the Quick Start Guide. And I might even throw something else in there for you. But you got to send me an email, Chris@themoneymultiplier, letting me know you booked a call or bought a hat. All right. Thanks so much, Craig, and Stephen was a huge help, and Shauna, thanks for all you do on the back end. And with that being said, we'll see all of you at 4:30 this afternoon for Ask Me Anything Happy Hour. Hey, I hope you're liking this wealth webinar, and if you are, then do me a solid. hit that subscribe button right now. We do this webinar each and every week, and if you want to know about the next one, the link's right down below. So sign up for the next wealth webinar every week, 1 p.m. Eastern. But also, if you want to be notified about all the events we do, right above there's a little bell. What I need you to do is I need you to smash that bell so you're notified every time we put out a new video and every time we're going live. We'll see you on the next one.